Good morning and welcome to the Hope-Filled Financial Podcast. My name is Jay Disberger, your one and only Hope-Filled Financial Coach, and I'm happy that you're here with us today. For the entirety of today's episode, we're going to be discussing credit cards. But before we do that, I want to encourage you to subscribe to the Hope-Filled Financial Podcast. We publish a brand new episode every Tuesday. I also want to let you know about a project that I've been working on this week. By the time this episode comes out, it should be live on the website, and if it isn't quite yet, it should be out any day. This project is a marriage enrichment workshop that could be offered by your local church. It's called Your Marriage, God's Word, and Money. This workbook embodies months and months of research and dedicated work in order to put together the single most effective marriage enrichment workshop to teach you and your spouse about God's will for you and your money. If this sounds like something you'd be interested in, please tell your local church about us. On our website, there will be a link for your church to get started in setting up one of these workshops in the near future. You're not here, though, to hear about the marriage enrichment workshop. You're here to hear about credit cards. That's today's main topic. This episode could very well be called Confessions of a Financial Coach. When I was homeschooled, I went through Dave Ramsey's curriculum for personal finance. I think it's called Foundations in Personal Finance or something like that. This curriculum set me up to believe firmly from that point forward that credit cards were not my friend. Almost all of you listening have certainly heard of Dave Ramsey, and Dave Ramsey's disdain for credit cards is most certainly public. I maintained the position that credit cards were something that I would never get into up until I was close to graduating. I was getting ready to move to the Salt Lake City area for my very first job as an architectural engineer. I knew when I was looking to move out that the real estate market in Utah was hot, and it was projected to grow even hotter over the next 10 years. Even though I didn't have too terribly much for a down payment, I knew it was going to be economically responsible for me to get into home ownership as soon as possible. The problem I ran into right here is the only hole where Dave Ramsey's manual underwriting does not work if you've been responsible with money. I especially didn't have a work history that reflected the new salary I was going to make as an engineer in training. Dave Ramsey promotes Churchill Mortgage as a lender who utilizes manual underwriting for those of his followers who do not have a credit card. If you become debt-free, and you don't have credit cards, you don't have a mortgage, you don't have anything in the way of debt, your credit score in short order becomes indeterminable. This is when manual underwriting is the only way that you can get a mortgage. Unfortunately, I didn't have what it took to make manual underwriting successful, not by my own fault and not by anything that I could have really done differently. It was just by the nature of where I was in life. Churchill Mortgage themselves told me the only way that I could get a mortgage is if I got a couple credit cards. I built up my credit quickly over the next few weeks and called them back and got a mortgage through the traditional route. This was my only avenue to become a homeowner right after graduating. The alternative path would have been to rent for a little while and build up that income history so that I could qualify properly for manual underwriting. But I wanted to be a homeowner. I didn't have the patience, so I broke down and got my first 2 credit cards. And it did indeed work. I used the credit cards just to fill up gas for a short while. I got a credit score that populated, and it was one that was good enough for me to get a mortgage. I ended up buying a 1,400 square foot condo in Bountiful, Utah. It was a wonderful first property, and it served me really well for 4 whole years. Right after moving out to Utah and getting the home, I ended up, because I had the credit cards, missing a month or 2 of budgeting. I remember going out with friends from the office, and we would go out and eat for lunch. Sometimes we would get dinner. That first month, I was not only skipping my budget, but I was putting everything on a credit card. I ended up spending $800 on food just for me. And it was because I, A, wasn't running a budget, and B, was using a credit card. I wasn't even registering how much money I was spending while I was spending it. That's what credit cards are excellent at getting you to do. While we were engaged, my wife and I got a credit card that we shared in order to pay for wedding expenses. Since I was in the credit card game anyway, might as well jump on this one and get the free airline miles so that I could fly out and visit. You see, we were engaged long distance. We were 1,000 miles apart as the crow flies, and I would make it my number one priority to fly out at least once a month to visit her. Fortunately, we had enough friends who were getting married back in Kansas. We basically made going to a wedding a monthly date. I think we had at least 4 or 5 active credit cards between us, and we had a couple more that were just sitting in a drawer not doing anything. As you know, I am passionate about budgeting, especially in marriage. Naturally, I needed a budgeting tool that was going to be able to draw from all the transactions from all these different cards and the checking account and organize them in such a way that I could track my expenditures in each and every category accurately throughout all these different accounts. The process was cumbersome. I spent weeks building this super spreadsheet, and I had like multiple legends in it where you could input the expenditures from up to like 25 cards. Heaven forbid we ever had that many. I wanted to future-proof this thing. But it took a lot of work, and that spreadsheet was complicated. And I know complicated spreadsheets. I've made so many. Now, even though I had a spreadsheet that was designed to take all these different inputs from all these different sources, all these different accounts and cards, it still didn't make reconciling the budget and putting in the different transactions any faster. It still took a great deal of time to get everything organized, and it would take forever if I needed to track down a particular expenditure. I remember sitting down in budget meetings with Amanda, and I would pull up one legend from one credit card, and we'd be sifting through looking for the particular transaction for one particular category, and we couldn't find it. Well, it was in the one over, and when we filtered out on that, it would hide the transaction we were looking for in the adjacent ledger for another credit card just off screen from where we were looking. So budgeting with credit cards was not working out very well. It was just simply too complicated, and it was taking significantly longer than I would want a regular budget meeting to take. We ended up basically taking all of our credit cards and putting them away. We just simply stopped using them, and we only used the debit card just to test drive budgeting with only one account. It went so much better. Not only were things easier to track, and I could actually go throughout the month and easily pull transactions and keep the budget up to date so that we could know where we were in the budget. But if I needed to find transactions later, as we're reconciling things, it was all in one simple ledger that the budget was referencing, not up to 25 ledgers, one ledger. Simplifying this process made budgeting so nice. Our budget meetings, after I would draft a budget for us to review, could take as little as 15 minutes. Amanda and I actually just had our budget meeting for March today, and it was something that we were able to casually just walk into after lunch. Hey, I got the budget ready to go. Do you want to check it out? We went through it. It was simple. It was fast. It was easy. And it's been that way ever since we stopped using credit cards. We held on to the credit cards for a little bit of time, just enough time for us to start hosting a Financial Peace University class at our local church in Bountiful. Shout out to St. Olaf's Catholic Church and Father Andrew for letting us facilitate Financial Peace University. In Financial Peace University, there's a part of the class, a part of the debt lesson, where they have you cut up credit cards. And if you're brave enough, cut up credit cards in the class. The facilitator is asked to bring scissors. And if they have any credit cards, cut them up there. So I ended up bringing our credit cards and cutting them up there in front of the class as an act of inspiring them. We closed the credit card accounts later that next day, and we've never gone back to touching them. I want to add, Amanda and I never, ever carried a balance from one month into the next month. We always paid off our credit card balances because the amount of interest that they could have charged on some of those cards exceeded 28%. It was insane. And there's no way that we could build wealth and get ahead if we were paying that amount of interest on any balance that was carried month to month. And that basically entails my entire personal experience with credit cards. And now that I've shared this with you, let's move on to today's budget tip. Growing up, my family loved to take vacations every other year or so to Disney World. My 5 younger siblings and I adored that place for vacation, just not quite as much as my dad did. He was the #1 Disney World fan. If you and your family are planning on taking a vacation in the future or desire to take a vacation and just don't have the money for it now, today's budget tip should help. Today's budget tip is to set up a sinking fund in your savings allocation plan, in your budget, to cover vacations. vacations can oftentimes be large expenditures, and they're not the easiest thing to cash flow, especially something that you have to travel for. The last time I went to Disney World is when my wife and I were expecting Oliver. We actually had a really cool experience there in Disney World. It was the first time that she ever felt him kick. That aside, in order to make that vacation successful, we saved up over time a lump sum of money that we could use for vacation. And we took that money, transferred it to the checking account, and said, okay, we have X number of dollars we can spend. Being the nerd that I am, I actually made a mini vacation budget on my phone that we could reference as we went throughout the day. I knew, and Amanda knew, that we weren't going to outspend what we had saved for that vacation. And we knew that we had permission to have fun that we otherwise may have denied ourselves in the name of simply trying to minimize our expenses and make sure that we didn't outspend what we had saved for it. But on the whole, when you have a big expenditure, especially a vacation, and you're planning for it, you know when it's going to pop up, you know how much you're going to need to save every month in order to make that vacation happen. So set up a sinking fund for it. You can do that. It'll make your vacation all the more relaxing. Trust me. Next, we're going to answer a question from you. Today's question was submitted by Mary. Mary asks, how do I get motivated to start the debt snowball process? This is probably in response to the episode where we talk about actually getting out of debt. When we talk about the debt snowball, quick recap, that's where you list your debts from smallest to largest. You pay them off in that order, focusing all of your intensity on the little guy and only paying minimum payments on the debts that come later on in the snowball. There's some more nuance to it than that, but in a nutshell, that's the debt snowball process. So how do you get motivated for this? Well, there are two camps you can be in. One is you are fed up with debt. You are simply done with debt. And if that's where you are, that is your driving why. And that's what's going to push you to engage with a process that will free you from debt so that you can start saving and buying your future time back, taking control of your future freedom. But if you haven't hit that point, you probably fall into the second camp, which is where you have a working relationship with debt. Debt is a part of your financial life day to day. It's not hurting you that you feel emotionally. In fact, it's just sort of there. And you're like, well, I know I should probably get rid of it, but I don't, feel pressure to do it. And that's where the bulk of us in America actually fall, where we have this comfortable relationship cohabitating with debt. If that's you, what you need is a why in order to engage with the debt snowball process. You need to have a reason why you want to be debt-free. You need to have a positive goal in your future that debt is not going to allow you to achieve. For example, let's say you want to have $1 million in the next 15 years. If you run the math out and see that debt is holding you back from saving that money that you could otherwise be investing and working toward that goal of being a millionaire in the next 15 years, well, that's a why to get out of debt. Another place where you can find your why for getting out of debt is if you're not happy with your current work situation. If your job or your career is something that you're unhappy with, but you feel stuck in it because you have bills to pay, well, getting out of debt can give you the freedom to move past that. It can also, by giving you freedom of choice, simply enable you to re-enjoy the work that you have again. You may be doing something that means a lot to you, but you may not be enjoying it because you feel trapped, because you have promised your future away with debt. If you can look at your situation and get fired up about that and desire that freedom in the future so much so that you want it now, well, that can inspire you to get started with the debt snowball. Those are a couple examples, and it's what we have time for today. I hope that helps, Mary. Without further delay, let's jump into today's main topic, a review of IDFC's article, 10 Benefits of Using a Credit Card. All right, here is the article, 10 Benefits of Using a Credit Card. Now, we covered in the story today my history with credit cards, and you know my position now. You know I align myself fairly well with Dave Ramsey, even though I did use credit cards in the past. I'm genuinely curious to see what this article has to say. Okay, this article reads, you walk into a department store, pick a pair of jogging shoes, go to the payment counter, flash your credit card, collect the bill and receipt, and walk out of the store with your goods. The whole process is easy, and it took you just a few minutes. Here, no one has to worry if your bank knows and trusts you to repay the money for the shoes it paid. It's interesting that they say that your bank doesn't need to know or trust you to pay the money back. If you bought the shoes without a credit card, you would simply be using your money that you had in your account from the bank. The article continues. You don't have to go to the bank for a loan and explain the purpose of borrowing the money, because you'd need to borrow money for shoes, apparently. Instead, you could use your credit card to spend on anything, pay interest only on revolving credit, okay, and clear your outstanding at your convenience. A credit card has changed the way people shop by helping them have effortless credit on tap. You may have credit cards from several banks, and it is common for anyone to use a credit card to pay for the purchases or service. Well, this article is just going to be making all my points for me, basically saying that you pay interest when you have a balance, and in their words, you have credit on tap. You have access to easily, with almost no friction, outspend your income and do it without even thinking about what you're spending, just like when I way overspent on food. The article continues, you can find almost all banks and financial institutions offering various types of credit cards. They are accepted as means of payment at any place that offers you goods or service. The uses of credit cards are extended to buying groceries, clothing, and accessories, booking a movie ticket, shopping online, buying a home, appliances, paying your utility and mobile bills, and many more. Yes, you can use your credit card to buy anything. Says the benefits of credit cards are innumerable, and some prime ones are. I'm going to take a break and apologize if my English sounds a little weird. I think this article is written in a little bit of an awkward fashion. Okay, benefit number 1, buy on credit. I think that's the purpose of a credit card. What makes a credit card attractive is the credit limit allowed to the card holder. You can buy anything within that limit and pay later. Your monthly budget will not affect even if you buy items of higher value on credit. I gotta stop there and say, yes, you can buy things up to your credit limit. I've seen people who make $50,000 a year have credit limits of $250,000 a year. You could go out and buy cars to the tune of 5 times your annual income and put it on a credit card. Given the interest rates on credit cards, that's terrifying. I don't think that's a benefit. I think that's a drawback. One among the most important benefits of credit card is you can convert the total amount of your purchase into low-cost EMIs to enable you to repay easily over time. This helped revolutionize the shopping experience. Okay, low-cost EMIs, credit cards again, the average interest rate that they charge you on a credit card is 19%. It's over 19%. And I've seen credit cards that charge closer to 30%. I had one that started at 32% when I was on my credit card journey. That's not low cost, that's almost outright thievery. Benefit number 2, accepted method of payment. You can travel anywhere without carrying much money. If you have this card, being the most accepted method of payment, you can use the card to pay anything. Practically speaking, your debit card is going to be accepted everywhere credit cards are. Let's move on to benefit number 3, interest-free cash withdrawals. There are few credit cards that allow you to withdraw money up to a certain limit in case of emergency, with no interest charge for up to 45 to 50 days. Oh, how nice of them. You can make use of it in time of financial emergency. I think the majority of us in America lean on credit cards when it comes to emergencies, whether you use a cash advance withdrawal or not. But using a credit card for an emergency is a good way to turn an emergency, a simple emergency, into a financial crisis. If you put so much on the card that you can't repay it that upcoming month, then the interest that's built up can easily double or triple the initial cost of that emergency. That can be a huge financial setback. That's not a benefit. That's a drawback. On to point number 4. These cards come with reward points when you use them. For instance, IDFC First Bank credit cards offer unlimited and never expiring reward points, which are easily redeemable. It's funny that they have to specify that they don't expire and they're easily redeemed. When it comes to credit cards, there are a lot of reward points that do expire. And there are also a number of airline miles and other rewards that are very difficult to retrieve. I don't remember the exact number, but Dave Ramsey covered at one point how many millions and millions of airline miles go by unredeemed every year. And a bunch of those go unredeemed because they expire. Just the mere fact that they have to bring it up and highlight that their particular card doesn't gives you an idea of where the industry is. On to number 5. Benefit number 5, insurance coverage. You get personal accident coverage as well as comprehensive travel insurance coverage, and this is one of the significant benefits of credit cards, which make them attractive. Okay, accident coverage is interesting. If you have health insurance or a health cost-sharing ministry, and you end up in an accident where you're medically harmed and you rack up some serious medical bills, well, you should be deferring the risk that you can't take on yourself to your insurance company or your cost-sharing ministry. So I don't see much of a benefit to having an accident coverage other than it being redundant. It's possible that they're talking about a liability coverage when it comes to accidents, but again, there are other means that you should be covering your liability in areas where that risk is necessarily needing to be deferred, like liability insurance for your car. And when it comes to comprehensive travel insurance, I want you to think, would you buy comprehensive travel insurance if you didn't have a credit card, if they weren't giving it to you? Let's move on to number 6. Benefit number 6 says, make travel easy. We seem to be focusing on travel quite a bit. I think this is the second or third one. The article continues. The uses of credit cards in travel make them important. When it comes to IDFC First Bank credit cards, not sponsored by the way, they give you a unique experience through complimentary lounge access in airports and railway stations in India and priority check-in. Other than these, you can also enjoy discounts on food in more than 280 restaurants. Okay, I'm going to reiterate a point. If you wouldn't pay to get into an exclusive lounge at an airport or a train station, then why do you need a credit card in order to get in there? It's simply getting you to spend more money to have access to a benefit that you otherwise wouldn't pay for because it doesn't provide you enough joy or utility to get you to actually spend the money to get in the first place. Is it a benefit to get into those places? Sure, but it's a luxury and it's one that really doesn't have too much draw if you think about it. Benefit number 7 reads, discounts and cash backs. The advantages of credit cards extend to discounts on some of your favorite entertainment and dining outlets, travel and shopping apps, etc. You can also enjoy fuel surcharge waivers at petrol pumps across the country. To check the host of offers, click here. Don't click there. Okay, I got to give a shout out to, I think it's the YouTube channel Cracked or College Humor or something, but there's a series of videos out there. It's like the If Something Was Honest series, and there's a specifically If Credit Cards Were Honest video, where their recurring character Roger talks about credit cards and what credit cards would tell you if they were honest. Roger covers cashbacks and reward points, basically saying that a credit card encourages you to dig a really deep hole, and if you dig deep enough, they're going to give basically a handful of dirt and chuck it in the hole to help you fill it back in, but only after you continue to dig deeper. The point that video makes is incredibly valid, and it's basically that credit cards get you to spend more money than you otherwise would, and they use cashback incentives and discounts like this in order to draw you in and get you to spend more money. They actually encourage you to spend more money this way. Let's assume you have to spend $1 for every airline mile that you want to rack up. Well, to go on a trip then that costs you 50,000 airline miles, you would have to spend on your card $50,000 before you got a ticket for free, assuming you could redeem it, that would, cover that. That's an awful lot of money to be putting on a credit card. Now, it might take over time, But you can think of yourself if you go to the store, you're in the drive-thru, and it's like, well, I'd really like to go on this trip sooner, and I got to rack up the airline miles, so I might as well spend some more money. Well, guess what? You could have probably afforded that ticket faster, saving the money, instead of digging a hole with your credit card. We're almost done. Let's move on to number 8. The benefits of credit cards do not limit the shopping on credit. Instead, it helps improve your credit score. If you know how to use a credit card and how to make use of the credit period and repay the amount used on time, you can boost your, given this is a foreign article, I'm going to say what I see on screen, CIBIL, is the equivalent to a FICO score. This will help you obtain loans without any difficulty in the future. And they basically, again, make my point for me here. The idea of building up a credit score is so that you can take out more debt in the future. You take out debt so that you can raise your credit score, so you can take out more debt. And you pay back that debt so that you can raise your credit score. And you raise your credit score so you can take out more debt. On our Facebook page, I just posted a comic that I made that basically highlights this point. It's a young adult asking someone who's older than him, so, hey, why do I need a credit score? And they go, oh, so you can buy things that you can't otherwise afford because you won't have enough money. Well, why won't I have enough money? Well, because you're going to be paying your loans back. That's why. Well, why do I need loans? Well, paying back loans is how you build your credit score. So why do I need a credit score? The credit score has had some of the best marketing behind it ever since Diamond is a Girl's Best Friend campaign. We think in society today that a FICO score is an indicator of our financial success and our prowess. All it is a number for a lender to look at and say, yes, I believe that they are a safe bet. They will pay me back the loan. They will pay interest on my loan, and they're going to be someone I can make money off of. They found a way to identify who's going to reliably make them money, and they sold it to us in a way that makes us think that it is a reflection of our success. It was an absolute brilliant move on their part. But despite what they tell you in the marketing, despite what culture and society have figured is true, a FICO score is not a yardstick to measure financial success. Let's move on to number 9. Offer safety. You don't have to carry much money if you have a credit card. That was short enough. No, you really don't have to carry much cash on hand unless you run into a situation that doesn't take plastic. Basically, you'd have the same benefit of using a debit card, only with a debit card, you can't outspend the money that you have readily available to you. You can't outspend your income with a debit card. But you get all the same conveniences here that they say are associated with a credit card. Let's move on to number 10. Finally, keep track of your expenses. The statements you get every month from net banking helps you check your expenses and plan the repayment without delay. There are other benefits of credit cards, and if you want to know more about them, click here. Don't click there. If you skipped forward to the main topic and missed the story at the start of the podcast, basically tracking expenses in the budget is incredibly challenging compared to when you just have a simple debit card and checking account arrangement. Having multiple accounts that you have to review and track and investigate and hold on to, it makes it harder to budget and actively dissuades you from budgeting. It's not something that I think I would ever recommend to anybody who wants to genuinely track their expenses and take control of their money proactively with a real written budget. I think that will do it for us today on the Hope-Filled Financial Podcast. Next week, I don't want you to miss next week. Next Tuesday, I have an interview, a surprise interview with a surprise guest over a very high-profile topic. It's going to be so fascinating, and I cannot wait to share it with you. Until next week, budget bravely and enjoy your hope-filled financial future.